Regardless of the inflation read that we get in the Fed this week, we largely are pretty comfortable, I think, markets-wise in terms of expectations. Does it feel like we're now really looking at what happens next year and potentially the second half of next year, given market expectations that the Fed is going to have to put through interest rate cuts?
Well, that's my view. The Fed has clearly telegraphed what they're going to be doing on Wednesday. And as we look out to early next year, they've been fairly clear that they're close to an end to their rate hikes. And stocks have welcomed that. It's been an incredible fourth quarter for the equity markets. I'd call it a Santa pause rally in anticipation of this step down and then a pause. The risk, of course, is that something outside of their control, something maybe they're not even talking about. In fact, I can't remember a journalist asking Jerome Powell about the implication of China reopening and what that might mean for inflation of commodities and goods as 1.4 billion consumers come back to the markets after they've been really shut down and locked up for so long. I think that does introduce an upside risk to CPI globally that could force central banks not to be able to pause rate hikes when they'd like to early next year. It could be bad news for stocks and get off to a rough start next year.
Well, in fact, one of the sort of the reopening pieces that we've done here at Bloomberg, really crunching the numbers and looking at extraordinary upside potentially, in particular when it comes to commodities and energies prices, right? If we do get a full reopening out of China by, say, the second quarter or the middle of next year. But regardless of how that reopening plays out, is it fair to say that the fight against inflation is going to continue to be patchy, that there's going to be structural elements to that narrative that perhaps don't make sense if you're just looking for a straight story of the heavy lifting's been done by central banks and therefore inflation will come down? And how do you trade around that uncertainty?
That's a great point. And we've got different parts of the global economy and even different parts within economies rolling in and out of recession at different times. Right now, we're in a manufacturing recession here in the U.S., yet the service sector is doing strong. Just try and book an airline ticket or get a reservation at a restaurant. So it's very different than the everything, everywhere, all at once recessions we saw in 2020 and back in the great financial crisis of the late 2000s. And so that makes it very difficult to try and discern where's the bottom and where we're beginning to come out. I think volatility, therefore, is going to remain high. Each one of the last 6 months have seen stocks on a global basis up or down 5%. 3 of them were to the upside, 3 were to the downside. I think that could continue in the months ahead. So what investors should be doing is focusing on what's worked over the last 6 months, really what's worked in 2022, and that is high dividend-paying stocks. They've outperformed on the downside. They also are outperforming here in the fourth quarter. That's true in Asia. It's true in the U.S., Canada, Europe. The highest dividend payers are outperforming, even across sectors like the tech sector, for example, not a place you normally look to for dividends, but the highest dividend payers are outperforming. So that's one factor. The other is, I would say, low price to free cash flow ratios. Value stocks, in essence, are doing really well this year. They did so on the downside. They're doing so on the rebound. So as that volatility continues next year, implementing those two factors across your portfolio should help to insulate you from what could be some downside.
Where can you find more of those stocks, domestically or internationally?
That's a great point. So the U.S. is definitely known for high growth tech stocks, and so that's not where you're going to find most of them. These stocks that are possessing high dividend yields and lower price to cash flow ratios are generally found more in Europe and in Asia than they are in the U.S., and that's one of the reasons I think this year, which marked the first year international stocks outperformed the U.S. stock market in a decade, might be the start of a trend. We could see that happen again next year, and it would certainly be aided by the fact that maybe the dollar's headed on a downtrend as well.
Earnings estimates, are they too high right now?
I think that they are. If we take a look at the global recession, which I think is already underway, and indicators like the PMI or the global leading index from the OECD, they're all pointing to lower earnings numbers, though not a 20 or 30% decline in profits, but negative numbers that I don't think analysts have yet priced in, maybe negative 5, 10% numbers on a year-over-year basis in Q1 and Q2 next year. And the market, and currently analysts are looking more optimistically.